what is there in store for us today. So there are basically three parts of the study. One is the conventional number crunching for last 5 years, what has happened in the market. And because even when I look at the numbers, I find it very difficult to absorb that in 5 years, in last 5 years, so much has happened. And these are the winners, and the size of the win is just staggering. And interesting thing is that this 5 years start from a very, very depressed post-Lehman crisis. That's the base. So you'll find some interesting numbers which might, in the current market conditions, you might find it very strange. And then we have the theme 100x and market outlook. So briefly, the concept of wealth creation is process by which an entrepreneur creates wealth out of the money which has been entrusted to the company. And this is the most mystical and magical kind of process. And stock market is about entrepreneurship. And it is the future of entrepreneurship. So how exactly the entrepreneurs out of nothing, in fact, the best entrepreneurship is when money is made out of nothing. But still, I think it is not everybody's prerogative. Most of them, they start without any money. But when you list, there is always some amount of money, capital entrusted to the entrepreneurs. So how the entrepreneur has been able to enhance the value of what you are given, more particularly visible in the stock market. Then the net wealth created in last 5 years is the net wealth between 2014 March and 2009 April 1st. What is the gap between these two adjusted for the money raised? So that's how the largest 100 has been picked up. But the companies which have not been able to beat the market has done about 18%. The companies which have not been able to beat 18%, they have been left out as a wealth creator. Earlier we used to include them also, but we found that if you have done 2% on 2 lakhs and you to come in here, that's a wrong definition of wealth creation. So this time, since the markets have moved 18%, a lot of big companies have been left out as a wealth creator. Maybe with a very small margin, but like Reliance, Hero MotoCorp, Concor, and list is long, but very large companies who are conventionally into the wealth creators, they have not made to the list. So this is a very stringent and top quality wealth creators of 100 companies. We have 3 categories, largest, fastest, and most consistent. So the largest, this goes to TCS, of course, which is the largest market cap, number 1, and 3,63,000 crores at the rate of 51% compounded. In less than 2 years, the company has been doubled in last 5 years. This, 40%, if you do 40% compounded in 2 years, you double the stock. But at 51%, I think it must have required about 1 year, 7-8 months to double the stock. ITC, strange fellow out there, but it is always there, consistent, and most likely it will be there number 2, number 3, number 4 position in years to come. And sometimes it might even hit the number 1 position. HDFC Bank, Infosys is way below 4th number. Hopefully this is because nothing is threatening right now TCS position as a number 1. I can't see what can threaten in next 2-3 years as a number 1 position. During this period, the total wealth created by 100 companies is about 29 lakhs. Of that, almost 24% has been created by IT. So IT has played a major role in terms of wealth creation during this particular period. The fastest, I think everybody's dream is to have these companies in the portfolio. The best is Eicher Motors. Almost every year it has doubled in last 5 years, 94% compounded. Bajaj Finance, this one was visible to me at a very small price, and I couldn't believe that it has moved so much. Supreme, Amar Raja Battery, Page, they're all very good. This is the time, this time in the study, all the big and fastest, all the companies are very good companies. There is no company which is iffy in terms of making it to the fastest list. Then you have the most consistent. This is almost 15 years wealth creation. In 10 out of 10 studies, the one which have appeared, and within them also the fastest. So Kotak Mahindra Bank is 34% compounded for last 10 years, and I think they have still lot of steam left in terms of what they can do. It's a very large opportunity space, banking, and now recently they've got merger and all. So I think this momentum might continue at this thing. So Asian Paints, Sun Pharma, Hindustan Zinc. There is just one commodity company, that is Hindustan Zinc, and 8 out of 10 companies are consumer facing. So these are very, very sustainable type of wealth creation, and just because it has created wealth for last 10, 12 years, I don't think the story is over here. So there's a lot of force still left. To make it to this study, you have to have still firepower left to create wealth. Sensex have grown at about 18% compounded for last 5 years. In 2009, it was now 9,700, just about recovering from the collapse. I mean, collapse was at about, I think, 8,000 something, and now at the bottom it was, in March 9, it was 9,700. The earnings of Sensex have grown about 10%, whereas this 100 companies have grown at about 24%. And the P multiple, you see, the markets were at about 12p at that point of time, and all this fantastic set of companies, they were also trading at about 12, 13 times. But just see the earnings growth differential of 24 and 10 has led to very different amount of return. The WealthX company have given 34% compounded, all these 100 companies, whereas the index has moved only at about 18%. So huge gap. The businesses which have done well, the largest 24% of all the wealth created in last, I mean, we have created about 29 lakh crores in last 5 years. This is almost 30% of total market cap. Right now, as we stand, market cap is about 100 lakh crores, and about 29 lakh crores has been created in this study. And these 100 companies, out of that, 24% is coming from technology. Consumer is about 20%. Financials are 90%. Auto is about 11%. I think the one striking thing is that oil and gas, I mean, this is just about 1%. In 2009, it was 22%. So you see, I think this one is going to make a huge comeback. And we are seeing already the changes. Oil prices have crashed. A lot of reforms have taken place. Diesel, petrol have been deregulated. So I think this 1% is, I'm quite sure it will make it big. I mean, earlier, ONGC and Reliance, they were there for 10 to 12 years as the largest wealth creators. I mean, this is probably, I think, largest segment of the listed space. I mean, just the HPPP IOC itself is about 10 lakh crores of sales with almost zero profit right now. So I think this entire segment is going to come back. So watch out there in oil and gas segment, what you want to pick and where exactly you want to make money. But this is going to be exciting. This is, I think, the best slide of the study. Till about 2004, 50% of all the wealth created used to be the PSU companies. This study, only 2%, 5 companies. I mean, and that too, because of base effect or something, they came into the picture. Otherwise, PSU as a class is finished off in last 5-7 years of UPA government. So I think this has been the biggest loss to the nation, and this will become the biggest opportunity also. I mean, it looks, I'm also on the hating side of the PSUs, but I think I've not seen anything like this, that from 50% coming to zero, it's like a oil company thing that 1% contribution instead of 22. But from 50% to come to 0 or 2%, I think it has to reverse. And if governance is going to be good, if the autonomy is given to the PSUs and they transform themselves into a better managed companies, I think this one will be a most contrarian, most hated, most unpopular call to get into this. So I think this space is again, watch out. This is the valuation. So here we have the companies, about 45 companies were below P of 10. I mean, this is unheard of, that 45 companies would be below 10p in 2009. And the fear was so much that nobody, I think TCS itself was a hell 10p multiple in 2009. And it has delivered 51% compounded. So below 10p multiple companies have clearly given 42%. But after that, actually market is quite distributed in the sense that whether you bought at 25p or whether you bought at 12p or 18p, I think the distribution is pretty even. Even in price to book, I think in price to book there is no theme at all. You bought at very cheap price to book, typically you get slightly low return companies below price to book 1 but they have also not delivered anything very distinctly different. In fact, the expensive company between 3 to 4 book has been the best at about 44%. So clearly, buying cheap has not worked particularly well in last, something you bought below 10p, 7, 8p multiple, that has definitely worked, but otherwise, broadly it has not worked. But this one, which is a growth adjusted price to the payback period, what we do is, this is very, this ratio is found only here, and I use it personally big time, and it works brilliantly. This is growth adjusted P multiple, in the sense that you buy, today's market cap, if it is recovered in next 5 years, we call it payback ratio 1, and if it is 10 years, then we call it 2. So if you buy anything which can recover the current market cap in less than 5 years or less than 1, if you find that kind of stock, it's a multi-bagger to start with. So 45% return for 46 companies. I'm staggered to see that 46 companies out of 100 were available at less than 5 years payback period. Market was completely out of, it was very, very cheap at that point of time. And clearly, if you buy at 1, it is 45, and then 30 and 27. So the issue is that if you buy expensive, you don't have much chance to make this kind of a mega returns. This is the companies which destroyed wealth. The total destruction is about 207 lakh crores. Sorry, total wealth destroyed is about 4,18,000 crores, and 5 out of 10 of them are public sector undertakings. So again, few telecom companies and commodity companies, but basically 5 out of 10 are PSU. So PSU have been butchered all over. So this is some of the thoughts on what we saw in number crunching of last 5 years. But you can have much deeper understanding of the numbers when you go to the actual report. So 100x, the power of growth in wealth creation. Actually, when I started the study, the thought process of the study was that we do QGLP, and in that, quality, growth, longevity at reasonable price. So in that process, quality was understood. We have done a lot of quality stuff. How to measure growth, how to do blue chip investing, and all sorts of things. But we have not given enough of thought process in terms of understanding growth. And growth is the biggest multiplier in wealth creation. And so we have to, I'll talk a lot about it. So I want to do a project whereby let's understand a little more deeply about growth. And literature available on growth is very little, very scanty and very little. How to estimate growth, how to measure growth, how to approach the entire subject, what is the importance of growth, and how growth happens. Is it a hyper growth to start with? Is it there are phases of growth. So, and what is the difference between growth and quality? So all those things will come up in this thing. But what happened was, while we were doing this, for 15 days we were struggling, then we found a book called 100:1 in US. It's a classic book, you don't get in the print anywhere, but we got some Xerox copy of 100:1. And this book showed how to do how growth investing happened in US between 50s, 60s and 70s, and what are the characteristics of the companies which they found as 100 baggers. So they found about 300, 350 companies in 40 years. In US, about 300, 400 companies were found in 40 years. I don't know how they without computers, how did they do the number, but anyway, they did that, and they talked about, it's a very storied book, I would say, and we picked up a lot of stuff from there. So what we saw in Indian context, because we had 20 years data, so we said, let's understand growth through the eyes of 100x. And so we said, let's study all the super growers of this country in last 20 years. And that's where we converted the growth project into a 100x project. And here are some of the findings. So the most important piece I found, when you go to, what is 100x? What is 100x? When a stock multiplies by 100 times, that's called 100x, 1 to 100. So what you need, to make this size of money, and we are not talking about in 100 years to make 100 times. We are talking about 10, 15, 17, less than definitely 20 years. In less than 20 years, how do you make your money 1 to 100? And so it's a very difficult thing. But what it requires, the first thing it requires is the vision to see the target. Whenever you come across the company, what the vision which is required, because your in equity market is all about future. So can you see the future? And can you value it today? So at times you become insightful about it. So how do you make it a framework-based seeing the future? So first you require is vision to see them, courage to buy them. When you see them, can you buy them? Do you have courage to buy? Because there is most likely nobody will help you saving it, because you will be alone when you buy it. That's my experience. So you are alone. So you have to go and buy it. If you call up anybody, they will say it is not good. You don't know anything about it. So all the bad things they will tell you. Nobody will tell you that you go and buy it. So you are alone. So courage to see, courage to buy. I think these two are still doable. But really most difficult at this point of time is the patience to hold. Nobody holds it. I mean, I'm also as big a culprit as anybody. But the real problem is visioning is possible, courage to buy is possible, courage to buy enough is difficulty, but holding them is almost impossible. Now holding period has come down from a few years to few days, I think few months now. So I think this is a time to buy today and sell tomorrow, and they are the long-term investors themselves. So I think the real challenge is to find people who want to hold it for a long time. So 100x is stock prices rising 100-fold over time. The exact number is 100. 100 is not important. It's a concept. I mean, you have to think that you can make multiple times of it. Nobody can ever think would ever know how many times money can multiply. I know people who have done 1,000 times out of their investments. Like mother of all the growth stock in India so far has been Infosys. From day one, it was a prominent company, leader company, and growth company. And people came in for 2 years, people came in for 15 months, people came for 15 days. Everybody made money. And there are guys who started from day one, and they are still shareholders. So I think this is 4,000 times in 20 years. So these are the kind of super stocks you have. Then you have, so we'll get to the list and we'll talk about them. Now, what do you mean by 100x? Because 100x doesn't happen at simple rate of interest. If you do simple rate of interest, like it will take, forever to make it. It is because of the power of compounding. And I think when you're coming to stock market, I think this is the world of power of compounding. There is nothing happening in simple interest rate. So the compounded return, if you want to do 100x, in 5 years, if you do it, it is 151%. If you do it in 10 years, it is about 58-60%. If you do it in 20 years, it's about 24.5%, 26% kind of thing. So, but incidentally, as Motilal ji said, the index started at 100 in 1979, and it made 10,000 in 2006. It took 26 years for the index itself to do 100 times. At current price of 28,000, index was 280 in 1983. So it has taken about 30 years for it to become 100 times. So this is the market where if 30 times can be done by the index, it's a dumb thing. You don't have to apply, you don't need any manager. You don't need smart guys. And if you do 4-5% outperformance, I think the possibility of doing 20x 100x is very, very high. It's not a 0.01% kind of probability. Yes, it is difficult. You don't come across these ideas every day. But I think this is a land of multi-baggers, actually. Land of multi-baggers. We'll see the statistics. So why it is required? What is the importance of, why do you need a 100x or multi-baggers? You need it because investing is described as a process to laying out today's money to get more in the future. But actually, Buffett has made it a little more stringent 3 years back, defining investing as the transfer of purchasing power now with the recent expectation of receiving more purchasing power in the future. So the adjustment is the inflation. So he wants inflation and tax-adjusted return, which has to be significantly higher than today. Otherwise, why should you be bothered about coming to any other, whether it is a fixed income, whether you come to stock market, why should you go there if you don't get purchasing power? So here is the mathematics of it. If you see the first two, you start with one as debt and equity as one as debt. After 20 years, if it grows at 25%, equity becomes 100 times and debt becomes 4 times only. Only 4 times at 7% post-tax compounded. I think that's the rate you get right now. 7, maybe even lower. So it goes 4 times and equity goes 100 times. Inflation adjusted of 7%, which is the inflation so far. Debt remains 1 and equity goes 26 times. So you get 26. So if you surrender a Maruti car, say 5 lakhs rupees today, you should be able to buy 26 Maruti cars after 20 years. That's the power of equity. You know, that's the kind of, if you surrender 1 flat, you should be able to buy 26 flats after 20 years. That's the, I'm trying to make it feel a little better so that you can put more and more money into the equities. So this is how markets have moved in 30 years. This is a real, I think because some human behavior, people remember 2000 crash and more recent crash. I think the only memory, the people who are sitting outside the market, the only thing they remember is that in 2007 market crashed from 21,000 to 7,000. There is no other memory. Nobody remembers that it has become 100 times in 30 years. I have not heard from anybody. Or it has gone 7 times from 2003 to 2007. But everybody remembers 2007 to 2008 crash. I don't know. And that guides them that, okay, let's buy only fixed income, 90% fixed income, 95% fixed income. I think, I don't know what is the fixed income percentage in this entire crowd. It must be upwards of 50%. So you have two kinds of 100 baggers. First, transitories. Now, transitories are ones which are fat driven. They come and they are there for 2 years, 3 years, like companies like Satyam Computers, SSI. I think I have a brilliant practitioner who always identifies this one, and he's got a, and he has the guts to get out also at time. He calls it Hajariyas. So Satyam Computers, SSI, Unitech, I think Madhu and Bhatta both are masters of finding them and really making money out of them. And not that they don't pick up enduring ones. So we have picked the panel very, very carefully. And the enduring one, I think the real one is the enduring, meaningful size and scale of operations, saw stock prices rise 100x or more, and almost most importantly, maintained their X status after the event. Like after 30 years, you can peacefully go and sell it and enjoy. So that's what you want. After 100x, like Infosys, they started with 50 crores. The issuance was at 31.5 crores, got listed at 50 crores, and today it is 2 lakh crores. 15,000 crores is the total dividend. 25,000 crores waiting to be distributed. 12,000 crores annual profit. 4,000 times plus dividends. I don't know. This is crazy. And it has happened right in front of us. This is not a once upon a time story. This all happened right in front of us. I refused to go for IPO meet. For 2 years, I refused to take the presentation. I didn't know what is software. In 94, I didn't know what is the difference between hardware and software. So, that was the kind of ignorance we had. And here is the biggest industry out here. 24% of all the wealth created is coming from tech. So you need to be a little visionary. And our friend Bhatta was visionary to buy it at throwaway prices and still holding. And so you need that vision. I didn't have vision till about 97 to see the power of software. So this is the list of the super growers, 47 of them. As I said, Infosys 2,900 times, because the cutoff date we have taken is 1st March 94. By that time, it was already 7-8 baggers. So from there, then Lupin, I think this is a very surprise number that Lupin has made it to 1,200 times. And now it must be, if you count the last 6 months appreciation, maybe it is 2,000 times. So Wipro, Motherson Sumi, I think every single name should be uttered. These are huge things. Sri Cement, Kotak Mahindra Bank, Imami, Wakarangi, Eicher Motors, 452 times. This is till March. Maybe it is 1,000 times now. So, this is stunning. Asian Paint is the poorest of all at 106 times. So, now phases of growth. What happens is that it's not that it has taken 12 years. Average, it has taken 12 years, though it is a 20-year study. But 12 years don't happen at an even pace. It is not a 45-angle line. The first year is about 4.5 times. 5x. It happens 1 to 5 in the first year itself. Second year is, sorry, 3 years is about 9x. Then 5 years is about 24x. So the rate of increase cumulatively keeps going down. But getting that first 1 or 2 years is very important, this hyper growth phase. But it is not necessary that all the stocks will have hyper growth to start with. It can have a very, very slow growth in the beginning, and then it can pick up at the middle or at the end, like Sun Pharma. I mean, it was going at one pace, but now it has become violent in the sense that as the size is rising, the growth is rising even further, which is very strange. You know, it's getting a scale on a scale. So you can have very different types of, but getting the hyper growth in your pocket is very important, whether it is before you buy or after you buy sometimes. So when you we'll get into the characteristics of these companies, but it is very important to hold on. You know, that 12, 15 years, 20 years, that journey has to be completed. So what is the alchemy of SQGLP? I mean, this is our terminology. How do we, I mean, you have to give some shape to the entire investing process, and how do you justify, I mean, how do I look at it? Because there are million guys, million ways of looking at it, but this is our style of looking at it. And everybody will fall into this, they may call it differently. So size, I think one of the most distinguishing feature of all these 47 companies is that they're small to start with. Small, both in market cap and sales. They are very profitable companies, but very small and modest. The average revenue of all these 47 companies is, I think, about 250 crores, but the largest is about 650 crores. So clearly, we are talking about very small companies, though you have to adjust for the time factor. 10, 15 years back, these companies were small. But today, if you want to start, I would think that $500 million is a good number. So you can go up to 3,000 crores to start with. So first thing is, it has to be small. Second, which is more important, it has to be relatively unknown. So you have to walk alone. When you find something, don't tell it to, I mean, even if you tell any people, he's not going to appreciate, because you only know the story. So it is good that you keep telling and nobody acknowledges that it is a good story, then it is a good story. So, I mean, I have seen it time and again. Nobody accepts it. That's why it is unknown. So, whatever you know, whatever is your insight, but that vision has to be, has to be believed that it is unknown. And what happens is, when it is unknown, and you tell your 5 friends who are most brilliant and they reject it, then you think that you also start believing that it is a bad idea, and then you don't buy. So that's where, when you vision it, you also must have courage to act on your own conviction. You can keep doing analysis, paralysis, as it is called, but you have to someday act, and act with a courage, where you allocate 5%, 10% of your net worth. So if you're a 100 crore guy, I mean, buy 10, 15, 20 crores worth of stuff, because what you have in the portfolio, which is the largest allocation, say 20%, 15%, they are fat guys. I mean, one company which has made you big, but that cannot grow from there at that pace. So you have to see that the growth potential here is the highest, and hence you must, with courage, you must allocate much more. And that's what really makes a difference in the wealth creation. So small and relatively unknown. The next is the quality. The quality of business, quality of management. You have to have high quality business. What do you mean by high quality business? It has to be a business where generally there is a lot of profit, or a lot of profit potential is there. I would like to see a business where profits are already there, say banking, financial services, pharma, IT, consumer products. So when a new businessman comes in that particular field, it is much easier for you to figure out whether he's going to make money or not. But somebody starts making money in, say, airlines, where there is no money. Not only in India, there is no money in the world. And then somebody comes and, sir, I made 100 crores profit, would you like to buy? I'm not interested in buying that. Because I'm not saying that company may not prosper. It may prosper, but it will be headwinded, in the sense that, I mean, I don't want to apply my mind, because the tailwind is not on his side for the business in the long run. Today he's making money, after 2 years again it might go bankrupt. So it is better to stay in the businesses where there are large profit pools, which is there today in India in IT, pharma, banking, consumer, maybe in oil and gas now. Then it has to be one of the things is that value migration. I mean, the biggest value migration which is on right now. Value migration is the round the clock somewhere in the world, in some product, some company it is always on. But right now, $1 trillion value migration is on between the software, in the software industry from the developed world to developing country, more particularly like India. So from a $60, $70 per hour cost in Boston, all the work is coming here at $6 or $10, $15 per hour in Bangalore. And it's a huge trend, nobody can stop it. Even if the US government wants or anybody wants, they cannot stop it. So this migration is, just look at the size of the migration. In 2000, software services industry globally was about 500 billion. And we were 5 billion, so we were 1%. Today it is 960 billion, we are 100 billion, we are 10%. So we're given 10% share in the global software services. And the world is going nuts, they are going digital. So in next 10 years, probably the services will go to 2 trillion in 15 years. What will be our share? This year our share is about 35-40%. Would it be 500 billion, 600 billion in next 10 years? So that's what is staring at us. And that's a huge opportunity. Which companies are going to make it? That is for the guys. So we have to keep looking at generic migration in banking from public sector to private sector. I mean, will the public sector become, something like Doordarshan types? But that is 70% of the market. So there's a huge tailwind for the private sector, NBFCs and banks. So, so that you can keep going, say like strategic niche opportunities. Like in 15, 17 million motorcycle market, you have a Aisha which does just about 300,000, but makes money hand over fist. They're on seller's market, they're not on the buyer's market. So they can charge their price. Steel prices going down, petroleum product prices going down, they will raise the prices. So that kind of niche is required. Dominant share, Pidilite, United Spirits. I mean, this is the youngest country in the world, 50% market share with brown spirits and United Spirits. I mean, they're going to make money. The best business, best manager. How much money they can make, only time will tell. So economic mode, like Bosch. Bosch is almost 70%, 80% market share. I mean, no automotive in diesel will move without Bosch. So all the development, all the river linking, all the road making, all these guys, they have to buy diesel system and it has to be supplied by these guys. So there is massive money to be made. How much, I don't know. So I think you have to have your own themes, your own framework. There are many more frameworks which we have not put here, but you would be having, and you have to use them before you identify the idea. Quality of management, I think this is the most important one, more important than the business. Highest integrity, I mean, I think, first thing is the competence. I think competence has to be highest, which in India you find all over. The guys are very, very competent. Integrity, you never find in India. It's the most rare commodity in India. So you have to find competence and integrity. I think I always struggle with this, but I think I'm becoming better with the mistakes. I mean, more recently, the mistakes we have committed, that is making me better. I hope I'm becoming better. And then third is, which is most important for this kind of companies, is growth mindset, the passion, the 24/7 urge to take the company forward. The growth has to be kept going. And growth has to be kept going not by the external forces, by the internal management forces. And that is what is the differentiating between a company in the same field than other company. So you need the transition of the management so that you can keep importing new energy at the top end. The moment the top end energy goes away, you've seen in Infosys, the moment Narayan Murthy and Nandan's energy went away, they didn't replace with the good energy. Now they replaced with, I think, new horsepower. So hopefully it takes it again forward. So you need the growth mindset and passionate 24/7 physical raw pulling power. And so what happens is, at this juncture, it is said by Phil Fisher in one of the books that 90% is management, 9% is business, everything else is 1%. Keep that ratio in mind. So pick up the guys who are really big blasters. Now, what happens is, the growth is not only about sales growth. There is sales growth itself is two parts: sales volume growth, sales realization growth. So it is a multiplicative kind of thing. If you read the report, then you realize volume growth multiplied by price growth multiplied by margin growth means cost reduction multiplied by valuation growth. So you have 4 or 5 levers. People are focused only onto the valuation situation. 40p, It's very expensive. Don't touch it. I mean, yes, it might be right in most of the situation, but you can, if somebody tells me it is 40p, but margin is going to go 3 times more or 2 times more, then for me, effectively it is 17, 18p or 20p. I'm very happy to do that because nobody is focused onto the margin growth. And it is all multiplicative. Volume multiplied by price growth, unit price growth, multiplied by margin growth, multiplied by P growth or valuation growth, whatever, price to book, price to earnings, whatever. So when you understand all 4, then only you get the total growth. So you have to get 25, 27, 30% every year out of all 4 multiplied. So you have to be insightful about one of them, that also is good enough. Like every company has a different thing. Like Infosys has grown 45% compounded sales growth, flat, straight, no margin expansion. Actually, margin has contracted, even P has contracted from 40, 45 to 15, 17, whatever. So it was a one-legged horse straight on the sales growth. But most of the companies like Bata has done some 62%. I was seeing in this somewhere. Bata has, the volume growth is not more than, not even double digit. It's about 10, 12%. But price growth is 5, 7%. Margin expansion is massive, almost 10, 15% every year. And then P expansion. So all 4 combined have given you 62%. So you have to be insightful about how this, all these variables work. I think this is a classic one. The confusion between quality and growth. You know, one of the things I found, maybe it is in my mind, but one of the things I find, and I was not able to resolve for a very long time, is that all the great companies or great businesses, are they good investments? And I was not getting answer. If you have bought Colgate, I think you can't go wrong having big portion of your investment in Colgate, but it has not done well. If you see 20 years, it has just done about single digit, 9, 10% compounded. It's the greatest franchise in India. Why? The earnings have grown at about 10, 11% last 20 years. And it started with 80, 90p, and today it is maybe 45, 50p. So actually there's a de-rating, and eventually you made just about 9, 10%. So you are not become, you've done well, reasonably well. You've beaten the inflation, but you have not beaten the index, and you have not done very well. But at the same time, say like HDFC Bank, it's not as great a franchise as Colgate, but it has grown at 26, 27% earnings, and P multiple was about 20 to start with, now also 20. You made 26% compounded. In 20 years, you do a differential between 10% and 26%. I don't think, it makes great sense to stay with the quality but slow growth, particularly in this country where inflation is very high, and pay a very high price for high quality, low growth. So there are 4 quadrants: low growth, low profit. Sorry, low quality, low growth. It's a complete disaster, very avoidable. Low quality, high growth. That's the trap. And you need to be master of that, in the sense that you buy low and sell before others sell it. So, but it's a troublesome. Most of the retail, they get sucked into this, and they buy at the top, they only make the top, and then they become long-term investors and they sell it at a 80, 90% lower price. Or they wait for the next bull run so that they can cover it. So, that's another troublesome spot. So in high quality, again you get, high quality, but low growth. So this Colgate types, so you cannot die, you will do okay, but you can't amass big wealth. The real certified enduring multi-bagger or big growing happens on the top right. That is high quality, high growth. And if you can buy it at reasonable price, growth adjusted, I think you'll do very well. But that's where you have to position the entire portfolio very, very rightly. Markets are not positioned like that. Here you can't find ideas every day. You may find 1 idea in a year, 2 ideas in a year, maybe no idea in a year. But you have to be building your portfolio slowly. I think longevity has been the old subject, but longevity of goodness and longevity of growth. When longevity, quality, growth, and longevity of goodness and longevity of growth, when all these 3, 4 things come together, it becomes completely goofy for the market to figure out what is the right valuation. So we want to confuse the market by having the characteristics which market cannot fathom very, very easily. So what happens is, you have a Asian Paints, or you have a iShares, or you have a, say, even Infosys or whatever. So they start with they're great businesses, they start with high ROE, and then the competition comes and hits them. But you need to have the entry barriers or whatever advantage you have. and the long-lasting advantage. You have a brand, you have a patent, you have low raw material cost, you have the scale, nobody can touch you. So that's what guarantees you continued profit for 10, 15, 20 years. So longevity of the advantage is very important. And that's what happens is the market thinks that this company is good for next 10 years. Then after 10 years, you realize that this company is again good for 10 years. This is what happened with Asian Paints for me. In 91, I identified it's a terrific company, but I found it expensive. I thought next 10 years, profit is already discounted, so let's not buy it 20p. Then after 10 years, I realized that this is a very good company. So I was willing to pay 20p. Then by that time, the P multiple was 25 because market was discounted next 10 years. Then when I got agree for 25, then it went to 35. So I'm still not bought. So, this is what happens with the true blue chips, which have a rolling cap period extending. Then you have the price. I think this is the last piece of we go exactly in the same order. Price is the last. Because unless you have understood the entire spectrum of the real architecture of the company, you cannot value it. So valuation has to be favorable. It need not be dirt cheap, but because when it is very small, in any case, the option value is very high. So valuation, per se low value, if you start with 5, 6p, which you rarely become, lucky to get that, then it lowers your, like when Infosys came, it must have been about 7 at P multiple at 50 crores. So, it went up 7 times in first 12 months. So it lowers your total effort required to go to 100x big time. If you can do 5, 6x very quickly, then like in Hero Honda, I think between 96 and 2003, we were up about, say, 17, 18 times. So what was required to be done for next 12, 14 years, only 7, 8 times. Actually when we analyze, we realize that in 7 years, we did almost 20 times, and rest all 5 times has happened in 10 years. So I made very little money in last 10 years, but I was not aware of it. So typically, this is what really happens. You got to buy a little more reasonably priced. As it said that for human beings, there is no substitute of love. For investing, there is no substitute for paying right price. So, so how to apply for the future? Now we come to the almost last part of the presentation here. We have tried to look at it. We have not done a lot of work, but we just tried to show you how to go about it. Like market cap below 2,000, 3,000 crores, likely beneficiary of value migration or niche opportunity, P less than 25x currently. So this is definitely not a full research. It is just a screener we have done, and there is a potential that there must be something here. So, because of SEBI, we have put this, So these are companies which are looking to be good, but we need to do a lot of work. None of them are finalized as a recommendation, but these are companies which have good starting screener to look at. They are less than 2,000, 3,000 crores market cap, maybe around 1,000 crores. They are reasonably good management. They have reasonably good business. They have a longevity opportunity. So everything is in place, but we have not interviewed any of the managements. So we have to go and sharpen our own understanding of these businesses to figure out whether there is any one of them which is worth betting on. I think market outlook is not very important because, but have some thoughts. I have some thoughts on this, that market cap to GDP, profit to GDP, total aggregate corporate profit to GDP has almost bottomed out about 4.4%. This is the first year when the corporate profit growth will track the nominal GDP growth rate, about 11, 12% types. So I think this 4.4 is the bottom, and the peak is about 7.8%. So as the GDP gathers momentum, nominal GDP grows at about 11, 12, 13%. Most likely, in say 6 years, if GDP doubles, or probably in 6 years, corporate profits has a potential to go 4 times. And since valuation is reasonable, I think markets can have that kind of attraction going forward. So interest rate is, the discounting factor is looking to be headed down to more like 5% all-time low. Particularly the oil thing is not still factored. So still we are counting, Mr. Rajan is taking his own time, but my sense is we are headed for record low in terms of interest rate. Let's see where it stops. Because what's happening in oil is unprecedented. This is as big as bubble burst. It's an oil bubble burst. Energy table has completely slumped. and it will have huge repercussions across the industries and businesses, and market has not even moved 10% on that. So I think there is a huge, in next 2-3 quarters, it will be clear who is benefited, who has lost, and what is the global implication of this. So, but I think for India, it is a amazing development. One factor where market looks very reasonable is here, the market cap to GDP, which is a very broad ratio. It doesn't look at anything else, just the one number. So we are at about 0.77 or maybe 0.8, something like that, because GDP is about 122 lakh crores for the current year, and market cap is around 9900 lakh crores. So we are in this sweet spot right now. I think we have gone in 2007 to the peak of 1.8, and now it is about, as I said, 0.8. So on a 1.5 year basis, when we'll be at about 135 lakh crores of GDP, we are at 100. So if we move from here to say 130, I mean, in next 15, 17 months to 135 lakhs also, I think we could be doing more like 35-40% appreciation in next. So, you know, it's a very good number to talk about. I don't want to predict, but that kind of potential is there if everything falls in place. When oil has fallen in place, interest rate will fall in place. I hope the investment cycle, which is very well awaited, also finds place. I mean, in the sense that the kind of pressure, all kinds of nuclear deal and auto deal and bullet train deals, and those things are being built up. Maybe it will take some time. We are losing patience. And if market loses patience, I think that will be the God-sent opportunity to put in whatever is left to be put in the market. And the people who want to get back into the, I mean, put more money into the market, in fact, they should pray to the God that let the market come down by 10% so that they can put everything, rather than saying that let the market not correct. This is how the markets look in terms of P multiple. We are at about just above the average at about 16, 17 times. So in conclusion, 100x stocks are few, very few. Please mind it. I mean, it's not even 1 out of 50 in a common situation. It takes little while to find multi-baggers. 100x stocks are few. Finding them requires vision to see, courage to buy, and most important, patience to hold. It is said in that book that patience is rarer of the all three, and I think ladies seldom have it, and men never have it. So it is so difficult to have this patience, and in this dynamic, nanosecond price change. So that's the most important one. Value migration offers the most predictable 100x opportunities right now, and it is not a local value migration, it's a global value migration. 100x processes are captured in SQGLP. In evaluating a common stock, the management is 90%, industry is 9%, and all other factors is just about a percentage. So focus on quality of management. Quality does not guarantee growth and in turn rapid long-term wealth creation. You need to have growth and quality both. Subject to global factors, expect 50% upside in the market in next 2 years as market cap moves more towards GDP parity. Thank you very much.